Welcome back to Gold Rush Reporter, where we dive deep into gold and silver markets to see what's really happening behind the charts. If you're serious about protecting your wealth and understanding precious metals, you're in the right place. Today, we're talking about something huge. Gold has doubled in the past 2 years. That's right, $1,930 in November 2023 to nearly $4,000 today. It looks amazing on a chart, but here's the question. Has the underlying currency, the dollar, held its value during that time? My gut says no. When gold moves this fast, it usually signals big changes in the money behind it, not just the metal itself. Historically, gold's biggest jumps didn't happen because it was a hot investment. They happened because the currency was being reset or devalued. Let's put this into perspective. The most similar move in modern history happened 1979 to 1980, after the US left the gold standard. Gold went from $200 to $850 in just over a year. That's a 4x increase. But it wasn't just gold winning. It was the dollar being redefined as a pure fiat currency. Your gold was buying what paper money no longer could. Before that, we saw other spikes too. After the 2008 financial crisis, gold ran from $700 to nearly $1,900 in 3 years. Banks were collapsing, credit markets froze, and the Fed flooded the system with money through zero rates and quantitative easing. The rally didn't start in the panic. It started when liquidity was abundant and the dollar had been effectively diluted. Even further back, in 1933-34, gold spiked 69% overnight, not because of market demand, but because Roosevelt forced Americans to sell their gold at a fixed price and then revalued gold from $20.67 to $35. That's a 40% devaluation of the dollar. The lesson is clear. Gold surges when money changes, not just when it's popular. Now, today's rally is catching everyone's attention because it's happening fast. But history tells us to ask a bigger question. Is this just a great investment, or is the dollar itself under pressure? The US has $38 trillion in debt, rising interest payments, and countries are reducing dollar holdings while increasing gold reserves. Those aren't small details, they matter. Before we go further into today's gold trends, here's a quick sponsor note. The Majuba Hill Copper Project in Nevada, run by Giant Mining Corp., BFGFF, is trading near its 2025 lows after a 70% drop from earlier highs. With US policies prioritizing domestic copper production, this project could be central to America's push for mineral independence. Copper is critical for AI, defense, and green energy. Infrastructure is ready, past production is proven, and now is the moment to pay attention. All right, back to gold. Doubling in 2 years is remarkable. But history warns us, the most extreme rallies happen when the financial system itself is shifting. Gold isn't just climbing, it's being revalued against a changing dollar. Retail investors should ask, am I holding gold just for gains or to preserve value through a possible dollar reset? So let me ask you, is this just a normal gold rally, or is something bigger happening behind the scenes? Think about that while you hit like and subscribe. We're only getting started. Let's go back to the 1970s, one of the most important periods for gold in modern history. In 1971, Nixon ended the gold standard, making the US dollar a pure fiat currency. Until then, the dollar was backed by gold. After the change, the price of gold was free to float. It climbed from $35 to $850 by 1980. That's over a 24x gain if you held gold starting in 1971. Even after the price corrected to $350, your gold still preserved purchasing power, roughly 10x the value of your original investment. This wasn't just a lucky trade. It was protection against a system-wide currency reset. Here's a real-world example. If you had 56 ounces of gold in 1971, it was worth about $1,960. By 1980, that same 56 ounces could buy $47,600 worth of goods. Enough for the average US home at the time. That's why we call gold a bridge between financial systems. When paper money fails, gold holds value. Even more extreme, look at the Weimar Republic in the 1920s. Hyperinflation destroyed the currency almost overnight, prices doubled, savings were wiped out, and paper money became almost worthless. 1 ounce of gold could buy what a lifetime of savings used to buy. That's extreme, but it highlights a key point. Gold's biggest gains happen when the underlying currency loses trust. Now let's bring this to today. Gold's recent move isn't happening in isolation. The US dollar faces $38 trillion in national debt, rising interest payments, and reduced international demand. Countries are increasing gold reserves and trading in their own currencies, slowly moving away from the dollar. These aren't minor details. They're structural signals. History also shows us how gold behaves during crises. After 2008, gold climbed from 700 to 1900, but the timing is important. Gold didn't spike during the financial panic. It surged after liquidity was added. The Fed pumped trillions into the system, M1 money supply jumped, and gold reflected the new value of money, not just investor hype. Similarly, in 1933-34, the spike was not market-driven. Roosevelt's executive order forced Americans to sell gold at $20.67. Then the government repriced it to $35. That's a government-driven revaluation, showing how external events can move gold dramatically, independent of normal market forces. The pattern is clear. Gold shines during currency stress or systemic change, not just as a growth investment. So while it's tempting to compare gold to stocks like the S&P 500, history reminds us that gold is different. It's not about returns alone, it's about preservation and protection. That brings us to the key takeaway. Gold isn't just climbing in price, it's reflecting stress in the financial system. For long-term holders, the question isn't, will it go up tomorrow? But am I accumulating enough to preserve wealth if the dollar weakens further? Before we move on to part 3, remember this. Gold acts as a bridge, connecting one system to another. Past rallies during the Weimar Republic, the 1970s, and post-2008 crisis show that its power comes from stability during chaos. Today's market conditions hint at a similar setup, but we're still in the early stages. Now here's a question for you. Are you treating gold as a short-term trade or as a long-term hedge against systemic risk? Drop your thoughts in the comments, hit like, and stay tuned, because in the next part, we'll dive into why silver is also entering the spotlight and how the current gold rally may signal the next major move in precious metals. Silver often gets overlooked compared to gold, but its history shows it reacts even faster during financial stress. Unlike gold, silver has a dual role. It's both a monetary asset and an industrial metal. That combination makes it extremely sensitive to economic shifts, and today, both factors are pushing it higher. First, consider industrial demand. Silver is used in solar panels, electric vehicles, 5G technology, AI servers, and medical devices. In 2025, industrial consumption makes up 59% of global silver demand. Solar alone consumed 232 million ounces last year, and the pace is accelerating. China produces 80% of the world's solar panels. So as green energy expands, silver usage is locked in. It's not a temporary surge, this is structural demand. At the same time, supply is tightening. Most silver comes as a byproduct of other mining operations like copper, lead, and zinc. Even if silver prices spike, production cannot ramp up quickly. Mines face declining ore grades, permitting challenges and long project timelines. On top of that, COMEX inventories in the US have collapsed by 70% since 2020. We're looking at a structural deficit, not just a short-term shortage. When you combine rising industrial demand with constrained supply, silver is set up for major gains. We've already seen physical silver premiums climbing ETF inflows increasing, and silver miners outperforming gold in recent months. Even when gold stayed steady, silver and its miners moved up, a clear sign that capital is rotating into silver. Now, let's connect this to the broader financial system. Gold's rally signals stress in the dollar, and historically, silver often follows gold during systemic shifts, sometimes outperforming it. When fear hits, speculative assets like Bitcoin may drop sharply, but capital doesn't disappear. It moves into real, tangible assets. That's where silver shines. Michael Oliver and other analysts are warning that financial markets are forming dangerous patterns, like the broadening top in equities. When this pattern breaks, we could see stocks fall sharply, and with that, risk on assets like Bitcoin will be hit hard. Investors who want safety won't stay in digital assets. They'll seek physical, real-world value like silver and gold. Even in recent history, silver has shown its power. In the early 1980s, it surged with gold, preserving wealth while the dollar weakened. Today, with the US debt at $38 trillion and global currencies losing trust, silver isn't just a trade, it's a strategic asset. Investors who recognize this early have an opportunity to get ahead of the next big move. Here's the bottom line. Gold is the anchor, signaling systemic risk. Silver is the fast-moving player, reacting to both industrial demand and financial stress. If you're accumulating precious metals, ignoring silver now would be a mistake. Physical silver, ETFs, and mining stocks are all poised to benefit as the market shifts. First, let's look at gold. Even after doubling in the past 2 years, gold isn't just moving because it's hot. It's responding to structural weaknesses in the dollar and the financial system. Interest rates, the $38 trillion US debt, and declining confidence in fiat currency are forcing capital into gold. Historically, gold rallies aren't random. They coincide with systemic resets, and today is no different. The critical price levels for gold to watch right now are around $3,500 per ounce. This level has repeatedly acted as a ceiling over the past few months. Each time gold approaches it, some profit-taking occurs, but selling pressure hasn't been strong enough to reverse the trend. In other words, buyers are defending the price, and when gold finally breaks decisively above this range, we could see a major acceleration in the rally. Now silver. As mentioned, silver isn't just a follow-on to gold. It's a combination of monetary safety and industrial demand. Right now, silver is trading above $38 per ounce, with resistance near $40. Every time silver dips to $37, $38, buying pressure emerges. That tells us the market isn't waiting for a crisis to start. It's already moving. ETF inflows, physical premiums, and mining stock gains confirm that capital is rotating into silver. Silver miners are particularly interesting. Even when gold was flat, silver miners were outperforming, showing strong technical and momentum setups. Miners have recently broken out of long-term price bases, signaling fresh upward potential. This isn't hype. Charts and fundamentals both point to further gains. If silver breaks above $40, the next technical targets are $50 to $70, and the potential for even higher levels exists if financial instability escalates. The macro environment is also key. The stock market shows signs of a broadening top pattern, which historically precedes sharp declines in equities. When this happens, speculative assets like Bitcoin tend to drop rapidly. But the capital doesn't vanish. It seeks safety. That safety increasingly flows into physical silver, which combines tangible scarcity, industrial demand, and monetary value. Central banks and large institutions are also quietly accumulating silver. Russia, China, and parts of Europe are stockpiling, while ETFs see increasing inflows. This isn't a speculative trend, it's strategic positioning for potential systemic risk. Every ounce withdrawn from the market reduces availability for retail investors. reinforcing the need to act before prices surge further. Finally, consider the historical context. Past gold and silver rallies weren't just about short-term profits. They were about protecting purchasing power during systemic shifts. The same dynamics apply today. Investors who accumulate gold and silver now are not just betting on price. They're preserving wealth and positioning for potential financial resets. We've seen that gold has doubled over the past 2 years, a move not driven solely by market speculation, but by structural shifts in the US dollar. Historically, gold rallies of this magnitude have coincided with major financial or monetary resets, from the 1930s Roosevelt gold revaluation to the 1971 end of the gold standard. Today, with a $38 trillion US debt, declining confidence in fiat currency, and global central banks quietly accumulating precious metals, we could be witnessing another systemic shift. Silver is equally critical, if not more immediate. Physical silver, mining stocks, and ETFs show strong inflows, supported by industrial demand from solar, EVs, AI, and high-tech sectors. Unlike Bitcoin or other speculative assets, silver combines monetary safety and tangible industrial utility. Current price action shows support around $37 to $38 and resistance near $40, with potential surges to $50 to $70 if systemic risk escalates. Historical patterns and technical indicators confirm that investors are positioning now before the larger breakout occurs. For investors, the takeaway is clear. This isn't just about chasing short-term gains. Gold and silver are tools for wealth preservation, portfolio diversification, and protection against currency instability. Miners are outperforming even when gold is flat, showing early signs of capital rotation from equities and speculative markets into physical metals. Key points to remember. Gold protects purchasing power and preserves wealth during systemic shifts. Silver offers both industrial demand exposure and monetary stability, with current trends pointing to multi-year highs. The broader market shows signs of instability, including the broadening top pattern in equities, which historically precedes sharp declines. Central banks and institutions are quietly stockpiling, reducing available supply and creating a strategic opportunity for early investors. Practical steps for your portfolio. Allocate a portion of savings into physical gold and silver for long-term preservation. Consider silver miners for leverage, but be mindful of volatility. Watch key levels. Gold around $3,500 and silver at $40 for breakout confirmation. Stay informed about central bank movements, industrial demand trends, and broader market signals. As always, research is critical. Don't just follow the hype, look at charts, fundamentals, and historical context. History consistently shows that gold and silver outperform in times of currency, stress, and financial uncertainty. That's it for today's analysis on Gold Rush Reporter. I hope this breakdown has helped you understand the larger forces driving gold and silver beyond simple price charts. Remember, it's not just about the rally. It's about preserving wealth, understanding systemic risk, and making informed decisions. If you found this valuable, hit that like button, subscribe to the channel, and turn on the notification bell so you never miss an update. Drop a comment below with your thoughts. Do you think gold and silver will continue their historic run, or are we entering a different phase? Thanks for watching, and as always, stay informed, stay prepared, and keep following Gold Rush Reporter for the latest gold and silver insights.